Okay, let's put some questions to Kash Pashootan. He's our featured guest of the morning. Here comes an email from Jorge from Montreal. Thanks, Jorge, for your question. Here comes the email. Thank you for considering my question. You're very welcome. I would like to know your guest's opinion on the best pipeline dividend stock in terms of reliability of payment of the dividend and growth of the dividend over 1 to 3 years. I'm looking at Gibson Energy, Sobo, TRB, and Enbridge. Kash? Sobo would be Southbow, I'm quite sure.
Yeah, our choice there, Paul, would be Enbridge. You know, it's boring. It's there's nothing overly exciting. But again, we're talking about the pipeline space, so it doesn't get exciting. But that's okay. You know, we want investing to be boring. When you look at Enbridge, and the viewer is asking about dividends and reliability. When you look at Enbridge, for the last 30 years, they've raised distributions. They raised their dividend even this year by about 3%. You're getting about a 6% yield right now, which is really, really good. When you think about where GIC rates are and where fixed income rates are, to get a tax-efficient yield that's almost double what you're getting on a 5-year GIC. Now, of course, it's an equity, it's not a GIC, so the risk profile is different. But from a yield perspective, it's compelling. The stock is not overly expensive. It's trading at around 25, 26 times. But this would be our choice in the space. And the other thing I think that's interesting about Enbridge is that they are quasi or somewhat still quite active on the M&A front. So they more recently did an acquisition in Texas. They made an investment in an LNG project in British Columbia. So we like to see that in terms of the company's ability to continue to grow their free cash flow. So large, long-standing history of raising distributions and dividends, and some growth potential as well to continue that income stream as we move forward.
About a year or so or more ago, there was concern among some investors about Enbridge's debt levels. You don't seem concerned there.
Not as much, especially as rates are coming down. The cost of capital is coming down. That's a real benefit for everyone's balance sheet as it pertains to debt.
Okay, let's go to a second email. This one comes from our viewer, Melissa. Melissa, thank you for writing. Melissa asks, would you buy Manulife Financial for a long-term hold?
So look, I think Sun Life is, it's an interesting one because from one perspective, it's large, well-established, very strong brand power. From another perspective, you know, so that's positive as we look at the past. When we look at the future, we sort of look at some of these businesses and say, where's the real growth going to come from? Whether you're in the insurance space, you're creating mutual funds, or have a wealth management business, when we look at Sun Life, we don't really see them as necessarily being a leader in any one of those spaces. They do a lot of things well, but in terms of what are they going to be a market leader in as we think about the next sort of 5 to 10 years, that's where we have some pause. But the reality of it, or, you know, as I said earlier, is it's a great business, it's a great brand. I think that your dividend is safe. It's really about, you know, where does the growth come from? So if you're comfortable with moderate growth and you're getting a dividend while you wait, we like Sun Life. If you're looking for sort of a direct growth catalyst that you can bet on, that's where we have pause with Sun Life.
Any thoughts on Manulife, one of the other giants in this sector?
I'd say similar. Mm-hmm. Yeah, similar. I mean, these businesses went from insurance to wealth management to kind of back, and I think it'll be interesting to see what leadership does in terms of core focus as they think about the next 5 to 10 years.
Okay, we get a lot of questions from our viewers on this channel on BCE and what may happen to the dividend there. The company has put the dividend on pause for a period of a year after it made a large acquisition in the United States. Expectations seem to be building that a dividend cut at BCE is possible, and we need to say BCE is the parent of this television channel through its Bell Media division. What are your thoughts on BCE?
Yeah, I mean, look, I think the right thing to do is to cut the dividend for the business. Obviously, investors don't want that, especially because BCE historically has been, all the telcos historically have been names that you really go to for the dividend. When you look at the Canadian telcos, it's not necessarily a big growth story. It's more about feeling safe in terms of somewhere that I can park my capital to get distributions or yield. And given that yield being one of the main compelling or attractive parts of the telcos, and BCE being part of that, that dividend not being available and potentially being cut is, I think, problematic for why many investors are there. But being an investor with a longer term time horizon, I think we would applaud BCE cutting their dividend, because we do believe that it's the right thing in terms of it's short-term pain for long-term gain, and it's the right thing for the business to do as it restructures and thinks about being a competitive and relevant business for the future.
Okay. Interesting comments there on BCE, once again, the parent of this television channel. Let's talk about the Canadian banks, which have come off recently as there's worry about the future of the Canadian economy. Of course, a big five Canadian bank has never cut its dividend. There have been periods of time, of course, where there have been long stretches of time where dividends have not been increased. What is your take on Canadian banks and dividends?
Yeah, so in terms of the Canadian banks, I think it was probably about last year, around this time, Paul, when I was on, and the banks hadn't started to really rally yet. And you had their dividend yields in many cases above the 5%. And when you think about the Canadian banks, not that we like to follow rules of thumb, but a good rule of thumb to really sort of drill into the banks from an investment and due diligence perspective. At any time you see the Canadian banks showing you dividend yields of over 5%, historically that's been a great buying opportunity, and the stock has rallied over the next 12 to 18 months after that. So we've seen that sort of play out. And so I think many investors are looking at it now and saying, you know, is the good better than the bad? What's going to happen? I think that the banks are going to go through a period here for the next 12 to 18 months where it's going to be challenging to really capitalize on growth. I think loan loss provisions are something that, for the most part, we feel are behind us. They've put lots of money aside for bad loans. I don't think we're out of the woods there yet. I think it'll be interesting to see what happens with interest rates here and inflation that will really impact the interest rates. I think for Canada, the small business owner is a big part of the exposure for the Canadian banks as well. And we talked earlier about tariffs and the implications that it can have on small businesses. So what I would say is that the uncertainties and variables that impact bank earnings today, those uncertainties are greater than they were 6 months ago. And so from a volatility and growth perspective, I do expect that Canadian banks will continue to be volatile in the coming quarters. If you have a longer term time horizon, again, they make sense. But again, remember that Canadian banks are not GICs. They're not bonds. You know, many forget that in 2008, Canadian bank stocks were down almost 50%. So the question to ask yourself, and I'm not suggesting that's where it's going, but as an investor, it's always about recognizing the characteristics of bad and good. Many investors should ask themselves, what would it feel like? Could I continue to hold this stock if it was to be down 20, 30% from where it is here? Again, not suggesting that's where it's going, but I do believe we're going into an environment of higher volatility. So those are good questions to be asking. Kash.